I'm often asked as a financial advisor, where's the best place to put my money? Is it real estate, investments, or insurance? And that's a pretty easy question to answer, but it really depends on who you're asking. The real estate agent will tell you only invest in real estate, everything that you need from appreciation, cash flow, tax benefits, find it in real estate. The investment broker will tell you invest everything in the stock market because of growth, income, tax benefits. You should only invest in stocks. The insurance agent will tell you should put everything into insurance, not only for protection, for savings with tax benefits and tax-free income. Now, the real answer is that you should utilize all three because they all have separate and specific benefits. During the next few minutes, I'm going to give you the benefits of participating in these assets and also potential drawbacks to take into consideration. An important term to understand is fiduciary responsibility. It's a legal obligation that requires a person to act in the best interest of another party or client. Fiduciaries are legally required to prioritize the interest of their clients over their own. And it's essential that when you're hiring a professional, you want to know that they're working on your behalf. Professionals that have a fiduciary responsibility to the client are registered investment advisors and real estate agents. The professions that do not have a fiduciary responsibility to the client, but have their fiduciary responsibility to the company that they work for, that includes insurance agents and registered representatives, although both must act in the best interest of the client. Let's start with real estate pros and cons. Pros include that you own a hard asset. You can touch it and you can feel it. You have unique leverage with the purchase in which you can put down maybe $15,000 and own a home valued at $300,000. Appreciation is based on the market value. And so let's say in 5 years that the home's appreciated to $400,000. You now have equity of $85,000, whether it's in a personal residence or investment property, like a rental property. If you sold that property at $400,000, your return on investment is 567% based on your down payment and the equity that you receive. Now, rental properties generate income. That income can be offset by any mortgage or expenses. There's no limit to the amount of properties that you own. And after the mortgage is paid off, they generate sizable income streams that can support your lifestyle or your retirement. Another beneficial tax treatment is that after you sell a rental property, you can use what's called a like-kind exchange, where you roll that equity into another rental property without incurring any capital gains tax. The average annual appreciation in residential real estate is somewhere between 3 and 5%, but it depends entirely on market conditions and location. The cons include that if you actively participate in your rental, you're going to have to find the tenants, you're going to have to manage the property, handle the repairs. You can also retain a property management firm to handle this responsibility, but it may cut into your cash flow, which makes it not profitable. Other cons include an unpredictable market, higher transaction costs, the risks of selecting a bad location, high vacancy rates, potential for negative cash flow, and obviously low liquidity. Real estate has had periods of substantial price declines. Most recently in 2009, where in high demand markets like Phoenix, Las Vegas, Miami, dropped over 50% and had lengthy recovery periods. The biggest consideration is that not everybody's suited to be a landlord. It can be very challenging, it can be frustrating and draining based on all the circumstances I just reviewed. With recent price appreciation and higher interest rate, it's also difficult to qualify for a loan to purchase the property, pay the mortgage, and rent the property out to cover all of your costs. For investments, there are 2 buckets to accumulate assets based on their tax treatment. A qualified investment is a retirement plan, like a 401k or an IRA. They have certain tax advantages of being able to have the investments grow tax-free. You can reallocate investments without taxes. And for a traditional IRA 401k plan, you have required minimum distributions. And to avoid any distribution penalty, you must start that by age 73. Since a 401k and traditional IRAs are pre-tax contribution, at distribution, they are taxed as ordinary income. They also have a 10% penalty if you need money and draw those funds before age 59 and a half. Roth IRAs are after-tax contributions. And the advantage is having now your distributions are income tax-free and you do not have RMDs. Roth IRAs are most beneficial for younger investors or those in lower income tax brackets, since the tax deduction for contributions is minimal. And then any investment that's not held inside a retirement account could be a bank savings account, self-directed or institutional brokerage account. They have completely different tax treatment. Investments that provide interest income, like from your savings or a CD, or provide dividends that are paid by stock companies, taxed annually. Any sale of appreciating stocks or exchange-traded fund or mutual fund, they're taxed as a capital gain in the year that they're sold. Therefore, you have more flexibility to sell or rebalance your funds in a qualified plan than you would in an individual account. The pros of investments are share price appreciation, dividends, protection against inflation, diversification, liquidity, and tax deferral until the asset's sold. Now, there's two types of mutual funds. They have managed mutual funds, which carry a higher expense ratio. It averages 0.75% or more because of the professional management. And then you have passive mutual funds, which have no active management and substantially less expense ratios, averaging about 0.12%, but many are much less than that as well. Now, exchange-traded funds are widely available, over 7,000 holdings. They can follow sectors, commodities, industries, or benchmarks. Common would be like the S&P 500 or the mid-cap and small-cap indexes. Now, to put this in perspective, $100,000 in a managed mutual fund, the average annual expense would be about $750. The same in an exchange-traded fund, that average annual fee would be about $120. Stocks have no expense ratio. They can be bought or sold anytime during the active trading day, and the price is based on the price at the time of that purchase or sale. I say that because stock prices change almost every minute during the day. Mutual funds, they close at the end of the trading day, which means that if you sell it in the morning, whatever price that was, you're not going to get that. You're going to get what the price was at the close of the day. That's what started the popularity of exchange-traded funds. They're sold much like a stock in that you get the price at the time of sale or purchase. The obvious benefit being that if the price is going down and you sell it in the morning, if it continues to go down all day long, you're going to get that initial price as of the time that you sold, and the same with buying. Stocks can be purchased in any of the 12,000 publicly traded stocks in the United States. They're held in the NASDAQ exchange, the New York Stock Exchange, and the over-the-counter market. As of December 2024, there was $63 trillion in market value. The 60-year average return of the S&P 500 is 10.2%. The cons of investing, they include risk of loss, and that can include up to losing your entire investment. Voluntary volatility, which means their values fluctuate. There's hidden costs, which might include fees and trading costs. Lastly, let's talk about the pros and cons with insurance. Now, for the most part, the purpose of insurance is protection. Auto insurance against loss or damage, life insurance against the economic loss due to a death, disability insurance for the loss of the ability to earn an income because of a disability. Long-term care provides funds available after a policyholder is unable to perform two or more activities of daily living. Now, daily living is defined as being able to bathe, dress yourself, eat, use a toilet, transferring in and out of bed or a chair or a wheelchair. And then lastly, continence. Now, the pros are obvious, but only after a trigger an event. I can tell you that in 32 years as an advisor, I've never met a widow that had too much money. Having disability income after being disabled and not having the ability to earn income, it's a lifesaver. Long-term care, it can make the difference between getting a loved one the necessary care that they need or living with their adult children. Now, I do want to distinguish in life insurance, there are two main products. The first one is term insurance, which is just pure protection. If you do not die during the period of coverage, there's nothing paid and there's nothing accumulated. The second one is whole life insurance, which has a savings component. It increases in value every year. It pays a dividend. You can get to the point where the policy and the dividend will support itself without paying any additional premiums. Whole life insurance can be both traditional and variable. They accumulate cash value. The cash value can be withdrawn, income tax free. The death benefit with life insurance is also income tax free. Whole life insurance is best suited for high income earners because of the tax-free accumulation and income, but it can be appropriate for anyone wanting to have a lifetime death benefit. Insurance products, purchasing decisions, they should be not based on cost. It should be based on the claims paying ability of the insurer. So look at ratings from AM Best and Moody's Investors to make sure that you get the benefits paid when needed. And don't assume that all insurers handle claims the same way. Outside of whole life insurance, there is no guarantee that you're going to have a triggering event to get a benefit from either term life insurance, long-term disability, or long-term care. But having said that, the peace of mind and financial security of these products is just the cost of taking care of yourself and your loved ones. I hope you found this information helpful. And if so, please like and subscribe to get more insight in the future. I want to thank you for joining me today, and I hope you have a prosperous day.